The world woke up to a shockwave no one saw coming. Markets froze, investors scrambled, trading desks from Wall Street to Toronto lit up in red as headlines flashed across terminals in rapid succession. In a move that blindsided Washington and rattled financial capitals across 3 continents, Canada abruptly severed a critical trade artery feeding the United States economy. Futures plunged within minutes. Currency traders braced for violent swings. Commodity screens flickered with sudden spikes. And at the center of the storm stood Donald Trump, caught off guard by a maneuver few believed Ottawa would ever dare to execute. It began quietly. No dramatic buildup, no fiery rhetoric, just a measured announcement delivered with clinical precision. Mark Carney, the former central banker turned political heavyweight, stepped forward with the calm tone of someone who understood exactly how much weight his words carried. Canada would suspend a major cross-border trade channel that U.S. industries had come to depend on, an economic lifeline deeply embedded in North America's supply chains. This was not symbolic posturing. It was not a marginal tariff adjustment. It was targeted leverage, applied at a pressure point Washington had underestimated for years. For decades, the economic relationship between the United States and Canada has been described as one of the most integrated partnerships on Earth. Billions in goods cross the border daily. Energy flows south. Auto parts shuttle back and forth multiple times before a single vehicle is complete. Agricultural commodities move in synchronized cycles. The assumption was stability. The assumption was permanence. Carney's decision shattered that assumption in a single stroke. Interdependence, once celebrated as strength, had been converted into strategic influence. Markets reacted instantly. S&P futures dropped sharply in overnight trading. The Dow opened lower as industrial and manufacturing stocks absorbed the first wave of selling. The Canadian dollar whipsawed, first plunging on shock, then rebounding as traders recalibrated expectations of domestic resilience. Oil ticked upward amid fears of constrained energy flows. Natural gas contracts surged. Gold climbed as investors sought refuge. Bond yields fell as capital rushed toward perceived safety. Hedge funds repositioned within minutes. Pension managers hedged exposure. High-frequency algorithms amplified volatility, turning uncertainty into measurable panic. The damage was not abstract. It was structural. Analysts quickly mapped out the exposure: energy corridors, automotive supply chains, critical minerals, agricultural exports. If even a fraction of these flows slowed, ripple effects would multiply. Logistics companies warned of bottlenecks within days. Manufacturers flagged potential production delays within weeks. The longer the disruption persisted, the more costly the recalibration would become. In Washington, the political temperature spiked almost immediately. Trump allies framed the move as economic aggression, a deliberate strike against American industry. Critics argued it was the predictable consequence of escalating trade rhetoric and hardline negotiation tactics. Cable news panels filled with economists debating whether this was a negotiating gambit or the opening salvo of a broader confrontation. Statements from Capitol Hill hardened in tone. Words like retaliation, countermeasures, and proportional response entered the discourse. Trump responded with characteristic force, vowing to defend American workers and hinting at sweeping counteractions. Yet behind the rhetoric lay a more complicated reality. Retaliation risked escalating into a full-scale trade war with one of America's largest trading partners. Restraint risked projecting weakness during a politically sensitive moment. Advisors weighed domestic optics against global consequences. Every option carried economic cost. Meanwhile, the sectors most exposed began calculating real-world impact. Energy markets stood at the epicenter. Cross-border pipelines and grid connections represent decades of shared infrastructure investment. Any sustained disruption threatens price stability on both sides of the border. Refiners recalculated input costs. Utilities evaluated contingency sourcing. Consumers feared higher fuel prices. Strategic reserves became part of closed-door conversations. The automotive sector braced for turbulence. Modern vehicle production depends on tightly synchronized cross-border components. A single missing module can halt an entire assembly line. Industry leaders warned that even temporary suspension of key flows could slow output, affecting thousands of jobs. Agricultural exporters voiced similar concerns. Grain shipments, livestock trade, fertilizer imports, each node in the chain depends on predictability. Spoilage, backlog, and contract disputes loomed as risks. Technology firms watched cautiously. Semiconductor materials, rare earth inputs, and specialized manufacturing components often travel through North American networks before reaching global markets. Disruption at one border crossing can cascade into delayed production cycles thousands of miles away. Supply chain resilience, once a theoretical discussion post-pandemic, suddenly became an urgent boardroom priority. Across the Atlantic, European markets opened lower. Asian exchanges followed suit. Investors recognized that this was not a bilateral quarrel isolated to North America. It was a stress test for global trade stability. If two deeply integrated allies could weaponize economic interdependence so abruptly, what did that imply for other strategic relationships? Emerging markets reliant on North American demand adjusted forecasts. Commodity exporters recalibrated price expectations. Insurance premiums for trade-related risk ticked upward. International institutions urged dialogue. Central bankers signaled readiness to stabilize liquidity if volatility intensified. Yet even measured reassurances could not fully offset the psychological shock. Markets can absorb bad news. What they struggle with is unpredictability. And unpredictability had just been injected into one of the most stable economic corridors in the world. Behind closed doors, negotiations reportedly intensified. Industry lobbyists pressed both governments for de-escalation. Corporate executives joined emergency calls, mapping exposure and contingency plans. Diplomatic channels buzzed, though public statements remained guarded. Each rumor of compromise triggered brief rallies. Each suggestion of escalation renewed selling pressure. Billions of dollars in market value shifted on a single headline. Strategically, both sides possessed leverage. The United States commands unmatched economic scale. Canada holds critical resource advantages and geographic positioning that amplify its influence in specific sectors. Carney's move demonstrated precision, tightening pressure at a node where dependency runs deep. Trump's potential countermeasures could target broader sectors, but at higher systemic risk. The chessboard was complex. One miscalculation could widen the confrontation beyond trade into currency or regulatory arenas. Political calculations layered atop economic ones. Domestic constituencies demanded strength. Business leaders demanded stability. Financial markets demanded clarity. The tension between these forces defined the unfolding drama. Each leader faced not only external negotiation, but internal balancing between ideology and pragmatism, between short-term optics and long-term consequences. As days passed, volatility persisted, risk premiums adjusted upward. Analysts revised growth projections modestly lower. Corporations accelerated diversification strategies, seeking alternative suppliers and backup logistics routes. What had once seemed efficient now appeared fragile. The lesson was stark. Integration delivers prosperity, but it also creates pressure points. For ordinary citizens, the abstract numbers translated into tangible anxiety. Retirement accounts fluctuated, fuel prices inched higher, business expansion plans paused. Workers questioned job security in exposed industries. Economic interconnectedness, often invisible in stable times, revealed its fragility under stress. Yet disruption often seeds transformation. Domestic producers eyed opportunities to fill gaps. Alternative trade partners explored new agreements. Policymakers revisited strategic stockpiles and infrastructure investments. What began as a shock evolved into a catalyst for structural reassessment. The deeper question extended beyond immediate retaliation or compromise. Had North America entered a new era where economic security outweighs efficiency, where strategic autonomy supersedes seamless integration? The pandemic exposed vulnerabilities. This confrontation reinforced them. Investors began pricing political risk more aggressively into models once dominated purely by fundamentals. Trump, seasoned in high-stakes negotiation theater, may yet pivot the narrative toward renewed leverage. Carney, disciplined and deliberate, may frame the decision as a necessary assertion of sovereignty in a shifting global order. But beyond personalities lies a structural recalibration. Trade lifelines are no longer assumed permanent. They are recognized as instruments of influence. Markets will eventually stabilize. They always do. Liquidity returns, volatility compresses, headlines fade. But memory lingers in boardrooms and treasury departments. Corporations diversify suppliers. Governments reassess vulnerabilities. Investors demand higher compensation for geopolitical uncertainty. The architecture of trade subtly evolves. The day Canada cut off that major U.S. trade lifeline will not be remembered solely for red screens and urgent press conferences. It will be remembered as a moment when the illusion of unshakable interdependence cracked under strategic calculation, when confidence shifted in real time, when the balance of leverage briefly tilted in an unexpected direction. Whether this becomes a footnote in a tense negotiation or the first chapter of a broader economic realignment remains uncertain. Diplomacy may prevail, retaliation may escalate, markets may recover swiftly or absorb deeper structural adjustments. What is certain is that economic gravity can shift without warning. And if one decisive announcement can send tremors through the most integrated trade partnership in the world, the question now confronting policymakers, investors, and citizens alike is unavoidable. In a global economy built on fragile interdependence, who truly holds the leverage when the next shock arrives?